then I think one sector which we've always struggled with is valuation of banks, because while discounted cash flow is taking off in banks, it's still challenging because there is one sector which works the reverse way. So in any other sector you would say, okay, I'll grow by 20%, and then for that I need this much capital. On the other hand, this is reverse. So in a bank you would say, if I have excess capital, then I can deploy that, and then I can grow my loan book this way. So it goes the reverse way. And the concept of free cash flows gets very difficult to establish in a bank, which is always going to suck in capital to grow. And if you grow, you have to suck in capital. So what really is a free cash flow? Typically we found that book value multiples, compared to return on equity over a long period of time, have been sort of a better approach. So you take the book, you take out the loan loss provision, and you try to see what's the multiple you're willing to pay. Considering what is the sustainable level of return on equity that is being generated by them. If as Ernst & Young, we found that to be a much better method. Although I do agree that a lot of practitioners also use this concept. So I mean, this is really on fair value. It's very pretty much if we say what is driving fair value of a company, it's growth. How much, how sustainable, how long it can be. It's risk. How much is the risk can be controlled? Is it in my hands? Do I have brands to manage my price risk, or is it all driven by global factors? Is it only national? And thirdly, I think management quality. I think not to be forgotten. It doesn't get into the cash flow straight away, but I mean at the back of it, it has to be very management quality, because you give an asset to one management versus other management, they can give you completely different returns on that. So not to forget the intangibles, the management that sort of gets into it. Which gets me to the second part of my evaluation, which will discuss aspects of premium and discount, and talk about that. So I don't know how to do it. 5 minutes. Okay. So let me just rush through this sector. So what we discussed was really fair value. But suppose you are acquiring, and we discussed some of this in terms of the new takeover code and all just before lunch. If you are acquiring a controlling stake, so what do you pay a different value, or do you pay the same value? So typically there is the concept is that the control value is higher, because you get the right to control the cash flows, as against somebody in a minority who doesn't have the right to manage, change, do something with the cash flow. So there is a certain way the company is doing, but if you have a controlling interest, you can change that, you can increase that, you can reduce that. So that impacts control premium. And governance also impacts control value, because in countries where governance is low, you find that control premium is higher, because minority interests do not sort of get the same level of returns that a promoter shareholder would get. On the other hand, the whole focus about takeover codes and SEBI and everybody globally has been to ensure that minority gets as much of these returns which the controlling shareholder would make as possible. Nevertheless, still the control premium remains in developed countries, it would remain in developing countries also. Marketable minority interest really is a reverse of control premium. So if I take, and I'll come to that how it's calculated, but if I, instead of controlling interest, if I minority stock, I will buy that only at a discount, because it doesn't come with all the rights. And then there are two aspects of minority interest. One is marketable, which can be traded in the market. So if you are in a listed company, then you have a marketable minority interest. On the other hand, non-marketable minority interest is somebody, you have a lack of control, and also you cannot sell in the market because it's not a listed company. And that is even much lower. So in a way, there are 3 levels of value. There is control value, there is marketable minority interest value. So if I do a multiples method based on stock market multiples, then I am calculating a marketable minority interest value. On top of that, we put a control premium, because if you are doing a control transaction, if you are selling a controlling block, then there is a control value. And below that will be a level of non-marketable minority interest, where if you hold minority interest in a smaller company, in a company which is not listed. Now, being in from Ernst & Young, keep doing some research about what's the control premium level in India. And this is sort of well tracked. In the US, there have been merger stat studies, which says premium is anywhere between 44 to 39%. And the way we track it is we look at all the open offers that have happened, what kind of premium was paid for changing control transactions. So if we look at the 26-week average, we find that median premiums have been 42% and mean premiums have been 60%. So if 6 month average price was 100, somebody's gone ahead and paid 160. So that's sort of in line with what is there globally. In US, it's slightly higher, but it's slightly trending. I think it's slightly trend down, but 30 to 40%, 50% kind of 40 to 50. I think median is a better measure because mean is getting impacted by some very high premium offers. But 40% is sort of considered reasonable from a global context. So Indian market establishes that there is a 40% control premium. Then minority interest is just a reverse of this. So if there's a 40% premium, the minority interest would be 40 by 140, so about 28%. That's the mathematical equivalence. Now, discount for lack of marketability, and this is something new. 2 years back, 3 years back, we didn't have a basis to calculate discount for lack of marketability, and you could just make assumptions and it could be value to value or be a different assumption. Lately, what has been happening is with the development of auction market, people look at it from a perspective of a put. So people say that if there's a listed stock, you calculate the put price. So if you say 3 year period and you say this is the put that's available for 3 years on this. So this is the price somebody is providing or market is providing as a guarantee to marketability. So people are saying, I am guaranteeing marketability of this stock at this price to you. So this kind of becomes the difference between the put option value of stock price becomes the marketability discount. Typically, you find that companies which are more volatile, they will much have a level of higher level of discount as compared to companies which are less volatile. Then, earlier than that, obviously there were some studies which said that pre-IPO valuations have happened in 100, but IPOs have happened at 200. So there's a 50% up on this, so 50% discount is there compared to IPO prices. But the challenge was that pre-IPO to IPO, the company may have grown and changed. So that was very challenging. Then I'll just run through this. I know I'm running out of time. So strategic premium over and above fair value, suppose you're buying 100%. There could be a certain strategic premium which could arise. And the reason for that could be twofold. One is really what is the valuation gain in target by your revenue efforts. So you're just taking the JSW Ispat example. So JSW could get in and say we will just refinance the loan. So we will cut interest cost significantly. Similarly, you could say that they come in and they say, okay, we're buying iron ore at this price, now we give a higher volume because we bring in Ispat also. The Ispat we cut it, we cut the raw material cost by this much. Or there could be, better say, a lot of basis of impacting the cash flow. So that's really overall the fair value, whatever you can do to cash flows to create value, that's strategic premium. And more importantly, it arises on what happens to you, how it sort of impacts you. And sometimes it happens that because of target, you will be able to realize better margins. An example of that, again in JSW deal, was that the moment they got in, they said that from now on, Ispat is only going to sell in the 200 kilometers around it, and we will sell in the region south. So, each of them would not compete with each other, they would sort of protect their margins, their market. So, not only will Ispat gain by better margin, but we would also gain by not competing with them in our own area. So, lower transportation costs, better margin, that's the sort of this thing. Then a lot of times strategic premium is also driven by kind of an entry strategy. Now what happens, you find for a company will come in and would be a higher multiple and you wonder why. But what they see is this gives them a beachhead. So the moment they come in, they can tap into other markets which are not open to them unless they come into the country. So there is some level of strategic premium that we see in terms of entry strategy. Sometimes it gives you an access to technology and you say that if I get that access technology to myself, then I am able to probably improve my own cash flows. And then a lot of times it's cross-selling. So, for example, one week we saw that a BPO company acquired another. And they said that, they are specialized and they have these customers. What we will do is we will get into these customers and we sell all the products that we are selling, all the services that we are doing. We'll only sell that also. So that gives us a further sales good in our company over and above, what is there in this company. So that was the driver of the deal. Again, sometimes you have a situation where you calculate what's the value lost if the target is going, especially if the target is your customer. And you say that if it goes away, if it goes to a competitor, I'm completely lost, I lose all this margin. So that becomes your strategic premium. Then sometimes lower WACC of acquirer versus target. Again, without naming the company, we were working for a Japanese company and they did the valuation first on the target on Indian cash flows, and then they said, we know we can finance it much lower. So then in the negotiation, it was fair value versus what's fair value, and they finally agreed to at least part with some of that value, which was really theirs because they could use a much lower WACC because their cash flows, cost of funding, everything was much lower. So that was one way to do that. Now, in a competitive situation, you'll find that some of these will go away. Some of the strategic premium you'll have to share in one-to-one negotiation. It depends really. So these are just some slides. I just leave it to you. Very, very simple. I think in each case scenario you have to do your own analysis as to how much of the strategic premium you want to pay or not. So just to end, finally I've been doing valuation for 16 years. Probably one thing is there. There is no such thing as a right valuation. You can never have a right valuation. So it's the values curse basically. If somebody tells me you've done exactly the right valuation, I know that's not right. So it's finally an estimate. But so if you are lucky, you may broadly get it right. But most of the cases, you get it wrong. Thank you very much.